Welcome to the Deep Dive. Today, we're really unpacking some key documents from Casey's General Stores.
That's right. We've got their recent Form 8K filing and the press release with all their latest financial results.
Yeah, these just came out. They cover the fiscal year that ended April 30th, 2025, and the fourth quarter.
Ah,
Plus, they give us a peek into fiscal 2026.
exactly. So it's a lot of information to sift through.
Right. So our goal here is pretty simple.
Yeah.
Help you understand what really matters in these filings. What happened last year, where Casey's seems to be heading.
And interestingly, how the executives get paid based on hitting those targets.
Exactly. We'll pull out the key numbers and try to connect the dots for you.
Let's do it.
Okay, so let's dive right in. Fiscal year 2025, the full year. What were the kind of big headline numbers?
Well, looking at the full year ending April 30th, it was clearly a good one for them. Net income reached $546.5 million.
Okay.
That's up almost 9%, 8.9% to be exact, from the year before.
And earnings per share.
Diluted EPS, yeah, that was $14.64, up 9.0%.
Hmm.
And EBITDA also saw really solid growth. It hit $1.2 billion,
Wow, 1.2 billion. That's up.
up 13.3%. So, yes, significant jumps across the board.
Solid numbers.
Yeah.
And I believe the CEO mentioned this being another record year.
He did, yeah. Darren Rebel has pointed that out and specifically tied it back to executing on their 3-year strategic plan. Seems like they feel they're on track.
Okay, so that's the overall picture. But, where did that performance really come from? Let's break it down a bit. Maybe start with inside the store.
Good idea. So inside sales, that's all the food, drinks, groceries, merchandise. For the full fiscal year 25, inside same-store sales, they were up 2.6%.
Right, and they gave that 2-year stack number too, which I always find useful.
Me too. It was 7.1% on the 2-year stack. Kind of smooths things out, gives you a better sense of the underlying trend.
Yeah, definitely. And margins inside.
Inside margin for the full year held up well, 41.5%. And that meant total inside gross profit grew nicely, hitting $2.389 billion. That's up from about $2.1 billion the year before.
Okay, nearly $2.4 billion in gross profit just from inside sales. How did the most recent quarter, Q4, look for inside?
Q4 inside same-store sales were up 1.7%. The 2-year stack was actually a bit stronger there, 7.4%.
Interesting.
Yeah. Inside margin for the quarter was 41.2%, so pretty much flat compared to last year's Q4. But the total inside gross profit for the quarter, that jumped 12.5% year over year to $582.4 million.
And they gave some specifics on what drove that inside growth, didn't they? It wasn't just one thing.
No, exactly. They called out prepared food and dispensed beverages specifically. Same-store sales there were up 3.5% for the full year and 1.5% in Q4.
Things like bakery hot food.
Yep, bakery, hot and cold food got mentioned. And then grocery and general merchandise also chipped in, up 2.3% for the year and 1.8% in Q4. They even mentioned non-alcoholic beverages specifically.
And the margins really tell a story there, right? Prepared food has a much higher margin.
Oh, absolutely. For the full year, prepared food margin was 58.2%. Compare that to grocery and general merchandise at 35.0%.
Wow, big difference.
Huge. It really shows why focusing on that prepared food and beverage side is so strategic for them and, frankly, for the whole industry. It's higher margin growth.
Right, becoming more of a food destination.
Yeah.
Okay, makes sense. Let's shift gears then over to the fuel side. How did that look?
Okay, fuel. For the full fiscal year 25, same-store gallons sold were basically flat, up just 0.1%. But the fuel margin was actually quite strong for the year, 38.7 cents per gallon on average.
So even with flat gallons, strong margins helped.
Exactly. Total fuel gross profit ended up at $1.236 billion for the year, which was up 10.7% from fiscal 24.
And how about the fourth quarter specifically for fuel?
Q4 same-store gallons were also just barely up, 0.1%, but total fuel gallons sold were way up, 17.8% higher than Q4 last year.
Whoa, 17.8%.
Yeah, that's a big jump. They said explicitly it was mainly because they were operating significantly more stores compared to the year before.
Ah, right, the acquisitions and new builds kicking in. That
Yeah.
makes sense.
Totally. The Q4 fuel margin was 37.6 cents per gallon, and total fuel gross profit for the quarter came in at $307.8 million. That was up a strong 21.4% year over year.
And there was something about renewable fuel credits too, RINs.
Yes, good catch. They noted a $4.3 million contribution from RINs in Q4 25. That's quite a bit more than the $1.0 million they saw in Q4 24. It's not core operations, but it definitely boosts that fuel segment profit.
Okay, so strong inside performance, decent fuel profit driven by margins and more stores. But adding all those stores costs money. What about operating expenses?
Yep, you nailed it. Total operating expenses were up significantly, 14.5% higher in Q4 and 11.5% higher for the full fiscal year.
And the main reason was
Yeah.
just having more stores to run.
That was the biggest piece. Yeah, they actually quantified it. Operating those 246 additional stores in Q4 accounted for roughly 12% of the total expense increase just in that quarter alone.
So the growth strategy definitely shows up on the expense line.
Absolutely. They also mentioned about $4 million in one-time costs in Q4 related to integrating that Big Fikes acquisition. And insurance costs also added about 3% to the Q4 increase.
Okay. But there was an interesting nugget in there about labor costs at existing stores, wasn't there?
Yes, this was quite interesting. They said same-store employee expense was actually flat, approximately.
Flat, even with wages going up.
Right. They managed to offset higher wage rates by substantially reducing same-store labor hours. So some kind of efficiency gain there at the store level.
That's pretty significant. Finding ways to manage labor hours while growing and paying more. That's key.
It really is, especially when you're expanding as fast as they have been.
Which brings us right to expansion. That seemed like a huge part of the story this past year.
Oh, massive. The documents state they built or acquired 270 stores in fiscal 2025.
270 stores in 1 year.
Yep. They said it was the most stores they've ever added in the company's history in a single year.
And a big chunk of that was the Fikes deal, right? The CECO stores.
Exactly. That acquisition alone brought in 198 CEFCO locations. So, that drove a lot of the store count increase.
So where does that put their total store count now?
At the end of fiscal 25, April 30th, they were at 2,904 stores, just shy of 3,000.
That's rapid growth. Okay, let's touch quickly on the financial side, balance sheet, shareholder returns. How are they looking?
They seem pretty solid. The debt-to-EBITDA ratio ended the year at 1.9x. That's generally considered a healthy leverage level.
And liquidity, do they have cash and credit available?
Plenty, it seems. As of April 30th, they had about $1.2 billion in total available liquidity. That breaks down to roughly $327 million in cash, and then $900 million they could draw on their credit lines if needed.
So financial flexibility is there. And what about returning cash to shareholders?
Good news there, too. The board just bumped up the quarterly dividend by 14%. It's now 77 points per share.
14% increase, nice.
Yeah, and importantly, this marks their 26th year in a row of increasing the dividend. That's a long streak investors like to see.
Definitely signals stability and confidence. Did they mention share buybacks?
They touched on it. So they didn't repurchase any shares in Q4, but they still have about $295 million left under the current buyback authorization. So they have the option.
Okay, so that wraps up fiscal 25 pretty well. Strong year, lots of growth. Now let's look forward. What are they telling us about the current year, fiscal 2026?
Right, the outlook. They provided guidance on several key metrics. For the big one, EBITDA, they're projecting continued growth, forecasting an increase between 10% and 12% for FY26.
10 to 12% growth on top of a record year. Ambitious. What about inside sales and fuel gallons at existing stores?
For inside sales, they expect same-store sales to grow between 2% and 5%, and they think the inside margin will stay strong, around 41%.
So continued momentum inside. And fuel.
For fuel, they're guiding same-store gallons to be roughly flat again, somewhere in the range of -1% to +1%.
Okay, so focus remains on driving inside sales growth while fuel volume stays stable. Makes sense, given the trends. What about expenses for FY26? Still growing.
Yep. Expenses are expected to increase again by approximately 8% to 10%. Still reflects growth, but maybe a slightly slower pace than the big jump last year.
Still adding stores, though, right? What's the plan for FY26 expansion?
They expect to open at least 80 more stores this year. It'll be a mix against some acquisitions, some new builds.
Still pushing towards that larger goal.
Yeah, they reiterated their aim to add about 500 stores total over their current 3-year strategic plan. So 80 keeps them on pace for that.
Got it. Any other financial projections for 26?
Just a few others mentioned. Net interest expense around $110 million. Depreciation and amortization about $450 million, and capital spending, like for property and equipment, around $600 million. And they expect a tax rate somewhere between 24% and 26%.
Okay. Now, this is where the 8K got really detailed. Executive compensation. What did it say about bonuses for last year and the setup for this year?
Right, the comp committee decisions. The 8K breaks down the payouts for the named executive officers, the NEOs, based on that strong FY25 performance we talked about.
So the cash bonus is tied to FY25. How do they actually pay out?
Based on hitting those performance goals, the payouts came in at 109% of the target bonus amount for each NEO, so slightly above target.
And they gave actual dollar figures.
They did. For example, the CEO's annual cash bonus payout for FY25 was $1,962,000. The CFO and COO each got $850,200.
Okay, 109% of target. Got it. Now, looking at the current year, FY26, how are those annual cash bonuses structured? What drives them?
The FY26 annual incentive plan is tied to two specific things. 60% of the potential bonus depends on hitting certain EBITDA targets.
Okay, profitability.
And the other 40% depends on hitting same-store sales growth targets, specifically for the inside sales category.
So really focusing on those key metrics, overall profit and that crucial inside sales growth.
Exactly. And the target bonus amount itself is set as a percentage of their base salary for FY26.
Like what percentages?
For the CEO, the target is 150% of his base salary. For the CFO and COO, it's 100%. Others are at 75%. But the actual payout can swing.
Right, based on performance.
Yeah, it can range from 0 if they miss the minimum goals, all the way up to 200% of that target if they really knock it out of the park on those EBITDA and inside sales metrics. Paid in cash.
Okay, so the annual cash is very tied to near-term operational results. What about longer-term incentives, the stock awards?
Right, the long-term equity incentive awards for FY26, these were also approved. They're typically granted as a target dollar amount or, again, a percentage of salary.
Big numbers here, too.
Yeah, pretty significant. The CEO's target award value is $9,275,000. The CFO's target is 325% of salary. COO is 350%, others around 275%.
And how are these structured? Is it just stock they get over time?
No, it's mostly performance-based. Only 25% of the award is time-based restricted stock units, or RSUs. Those just vest in equal chunks over 3 years, basically rewarding them for staying.
Okay, so 75% is tied to performance.
Exactly. That larger chunk is performance stock units, PSUs. And this piece is split again, half of it. So 37.5% of the total award depends on hitting return on invested capital goals, ROIC.
ROIC, okay. Why that metric?
Good question. ROIC measures how efficiently they're using their capital, all the money invested in stores, equipment, acquisitions to generate profit, including it really emphasizes profitable growth, not just growth at any cost, especially relevant given how much they're spending on expansion.
Makes sense. Smart use of capital. What's the other half of the PSUs tied to?
The other 37.5% is tied to hitting EBITDA goals over that same period.
So the PSUs depend on hitting specific ROIC and EBITDA targets over, what, a 3-year period?
Precisely. The award starts as a target number of shares. The actual number they earn is based on performance against those ROIC and EBITDA goals over fiscal years 26, 27, and 28. They can get 50% of target for threshold performance, 100% for target, or up to 200% for maximum performance.
But wait, there was another twist, right?
Yeah.
Something about shareholder return, TSR.
Yes, the TSR modifier. This is really interesting. After that 3-year performance period ends, they calculate how many PSUs were earned based on ROIC and EBITDA. Then they adjust that number up or down based on Casey's total shareholder return, stock price appreciation, plus dividends, compared to a group of peer companies over that same 3 years.
So how does that adjustment work? Up or down by how much?
If Casey's TSR is in the bottom quarter compared to its peers, the number of PSUs they earn gets cut by 25%.
Ouch.
But if their TSR is in the top quarter, the number of PSUs gets boosted by 25%.
Wow. So even if they hit their internal ROIC and EBITDA goals, if the stock lags behind peers, the payout gets reduced. But if they outperform peers, they get an extra kicker.
Exactly. It directly links a big chunk of their pay to how shareholders are actually doing relative to similar investments. If they hit maximum on the financial goals and land in the top quartile for TSR, the final PSU payout could actually reach 250% of the original target number.
That's a powerful alignment mechanism. Ties internal performance, capital efficiency, and relative market performance together.
Definitely. It creates a very clear incentive structure. These PSUs, after the modifier, generally vest all at once on June 15, 2028, assuming the goals are met and they're still employed. The filing also mentioned the base salaries for FY26, like $810 for the CFO and COO.
Okay, so putting it all together then, what's the big picture takeaway from these documents?
Well, it paints a clear picture of a company firing on quite a few cylinders in fiscal 25. Record results, solid inside sales, good fuel margins, and really aggressive growth through adding stores.
And they're aiming to keep that momentum going in FY26 with targets for more growth, especially in EBITDA and inside sales.
Yes, and crucially, the compensation structure detailed in the 8K shows they're heavily incentivizing management to deliver on those specific goals: EBITDA, inside sales growth, efficient use of capital through ROIC, and ultimately delivering strong shareholder returns compared to their peers.
So the strategy seems clear. Grow the network, drive those high-margin inside sales, manage costs through efficiency, and maintain fuel performance. And leadership pay is directly tied to making that happen.
Pretty much sums it up. For you listening, digging into these filings like this gives you a real window into what makes a company like Casey's tick the financial drivers, the strategic priorities, and how they motivate their team.
It really does. And it leaves me thinking, as companies like Casey's put more and more emphasis on becoming food destinations, focusing on that high-margin inside business, how will the market start to value them? Will strong prepared food growth eventually matter more to investors than, say, small shifts in fuel gallons? Feels like a fundamental shift is underway in this industry.
That's a great question to ponder. The identity of the convenience store is definitely evolving.